Hello, everybody, and welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to exit highly appreciated cryptocurrency, businesses, real estate, defer that capital gains tax, eliminate the need for the 1031 exchange so you can create and preserve more wealth. Hey, my name is Brett Sorts, and each and every episode, we're joined by some of the best real estate, financial, wealth, and cryptocurrency minds in the world, where they share their ideas, deal stories, and inspiration. So together, we can make complex tax deferral strategies simple and passive income plans achievable. I'm excited about our next guest. He's out of the great state of Massachusetts in the Boston area. He's the managing member of EM Capital Group and has over 18 years of experience in multifamily real estate investing. He is focused on acquiring commercial multifamily apartment complexes and markets across the country that exhibit positive growth trends. And he's passionate about the role that well-managed, well-maintained economic housing can play in helping to alleviate the current housing crisis and so much more. Please welcome to the show with me, Chris Lento. Chris, how are we doing?
Hey, how you doing, Brett? Happy to be here. Excellent.
Great. Good to see you. Get to have an interview with you here. For our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Yeah, sure. So I was in the aerospace industry for 18 years, mechanical engineer, ran a lot of programs for the Defense Department. And the entire time I was doing real estate investing on the side. So buying small apartment buildings here in the Boston area, renovating them, fixing them up, refinancing them to get bigger apartment complexes. And then probably 10 years ago, I moved to DC and worked directly for the government for a few years and saw the entire defense industry and where, my future would lie, what the slots were. And nothing was appealing. And I was really enjoying the real estate investing portfolio that I've been putting together. So I mapped out a plan and 6 years ago went full-time multifamily investing and started EM Capital. We focus on 100 to 250 unit mid-market multifamily, so Class B, C, and we'll do some A- apartment complexes, mainly in North Carolina down to northern Florida. We're looking for properties that have a value-add component, so poor management, capital improvements needed, and then interior renovations are also a great value-add. We buy them with investors, we improve their bottom line, and then we exit them in 3 to 7 years, market dependent. So it's been a great journey, and I like to apply a lot of my engineering best practices to multifamily, and it's surprisingly a large overlap. So that's
Awesome.
sort of my story in a nutshell.
I love it. You can learn more about Chris Lento by going to emcapitalgroup.com. That's emcapitalgroup.com. Hey, Chris, before we dive into today's topic, which is multifamily investment insights, I want to take one other step back. I believe we've all been given certain gifts in this life, and these gifts have been given to us to be a blessing and help to others. Some people call them strengths. Some people call them superpowers. What would you say is the one or two strengths or gifts you've been given, and how does that help how you help and bless people today?
Yeah. So one of the things that I've learned over the years that I'm particularly good at is kind of connecting / translating. So I'm able to take concepts and ideas from many different disciplines and kind of connect across them. So, if there's a tax strategist and there's an investor, I may not be an expert in tax strategy, but I can put myself in the investor's shoes. Maybe they're novice, and kind of translate for them. And this is applicable kind of across all disciplines, right? I remember when I was in the engineering world, I'd be in meetings and these two people are not connecting. They're just speaking different languages. And I have a kind of a talent for getting them to line up without anyone losing face or feeling like they weren't understood in the beginning. So I would say sort of a translator connector is one of the things I'm very good at.
I love that, translating connector. And so with that in mind, let's dive into multifamily investment insights and see if you can translate and connect what's going on. So what's the number one secret to what's happening in the multifamily investment world right now for that mid-market kind of deals that you're looking at?
Yes, there's I would say three major things going on. The biggest one, as everyone knows, is the interest rates. So, the Fed raised the interest rates at unprecedented rates, about 18 months ago now. And they've been steady for maybe 3 months or so, but that's had a dramatic effect on the market. And especially when they were moving so fast, it just really caused everyone to take a pause. The rate you pay for your loan directly impacts your cash flow. So as those rates were heading up, people were very reluctant to sell if they didn't have to. If they didn't have a loan due, they knew that the buyers were, not paying top dollar for their properties, so they were kind of on pause. And as a buyer, you're underwriting a deal, and in 3 months, your interest rate could be up, half a point, which is a big deal. So really, interest rates and what's going to happen with that is a big driver to the economy right now, or the multifamily environment. On top of that, we're seeing a lot of increase in manufacturing in the country. So a lot of these industries spurred by the Inflation Reduction Act are causing electric vehicle plants to be built around the country, battery plants. There's a lot of environmental, green energy manufacturing going on. And then additionally, there's just general, manufacturing increase as China starts to sort of slow down a little bit. And I think the U.S. economy is realizing that we need to start making stuff again. And we're seeing that. We're seeing a lot of, big projects going up in areas, mainly in the Southeast, which is where we focus on. And that's a big driver. And then what we're also seeing is some of the major markets that we like, we're a little bit overbuilt in their downtown core. And those markets are growing, so that will be absorbed. But for the near term, like Charlotte and downtown Atlanta, they're a little bit overbuilt. So we're kind of moving to the suburb markets for those areas.
Okay, those are some great insights so far. So interest rates obviously being the biggest one. Yeah. And then you touched on the downtowns, right? So I was in downtown San Diego, I was in downtown San Francisco this year, these different downtowns, and it's definitely different, right? And the question is, do you feel like it's going to get back? I mean, how different is it, do you think, as it was pre-COVID? And then what as far as investments into the downtown, do you see it coming back to anywhere near what it was before? Or like, what's your sense on that? Because we have such a housing shortage, but it just feels like more and more of these downtown corridors are just, people don't want to live there as much, or at least do things there as much anymore. But I don't know, maybe I'm off. Can you translate to that for us?
Yeah, so I kind of see that as two different downtowns, right? There's the older downtowns that have more of a density. So like I'm in Boston, this is an older downtown, New York, San Francisco, where those downtowns are like the epicenter of the area. And I think what's driving, those being slow right now is back to office. So people are not back to office in the volume they were before. Therefore, do you want to pay high rents if you can work from home? You used to pay these high rents so you could walk to work or have a short commute and have this energy. And since back to office has been far slower than people expected, that has impacted these kind of what I'll call older, kind of more dense downtowns. I think that's going to come back to a degree. I think it'll be rethought. There's every couple of months, right? A different major company has a back to office push, and it kind of sticks a little bit, and then there's pushback, and the percent in the office every week ticks up like half a point or some real low amount. So that's a good question as far as how much back to work will happen. But I see the rents in Boston are tight. New York rents, I think the vacancy in New York is 3.5%. So I think those cities will come back. And then there's the other category of downtowns, which is the sort of fast growing southern downtowns. So like Atlanta, Charlotte, Raleigh, those aren't as dense. They're very different than in New York City. They're kind of like a little urban center and then a lot of suburbs around them, really. And they're back already. I mean, they have had no change pre and post COVID. So yeah, I mean, and the only concern I have with the Atlantas and the Charlottes is that they've been slightly overbuilt. They have a lot of deliveries this year and I believe next year. And then after that, everyone, there's not much in the pipeline. So really that's just people are moving there. Those cities are growing. The developers were aware of that and they built to satisfy that demand. And then it's going to take a year or two for those to fill up and get balanced again.
You nailed it. You translated really well on that, right? That was really key. The old and the new downtown and where it's going and how they're going to reinvent it. And you're right. I think they always do eventually come back. It's not going to be back the way we would think it would be. And it might not be in the timing that we think it would be. But it will. It'll come back. I mean, those places are really amazing. Go ahead.
I think what COVID showed us is that everything's just slower than people expect, right? I mean, we all thought we were going to be back to normal in 6 months, and then it took 3 years. And then, people thought interest rates were going to start ticking down at the end of last year, and it's going to happen. But when is the big question. And it seems like in the last 5 years, everyone's learned that things just take longer when they're at this societal level to change.
Yeah, I agree with you. By the way, we're talking with Chris Lento. You go emcapitalgroup.com, emcapitalgroup.com. Now let's dive into multifamily investment insights as it pertains to just buying deals right now, right? So what are you seeing? What is your feel? What is your gut feeling for opportunities and where they're going? As it is, maybe it's back to what you just said before. Is it what you thought it would be at this point? Obviously it's taking longer. I mean, what is your take on just actual deals that you can buy that make a lot of sense right now?
Yep. So last year was extremely slow. Gotten a lot of best and finals where they got all the offers in, and the sellers decided, you know what, we're not going to sell. We don't like any of those prices. So they weren't. I wouldn't say they weren't serious sellers, but they didn't have to sell. They hadn't made the decision. Oh, we're going to sell at market rate. They sort of said, we'll see what we can get. And if we can get a great number, we'll take it. So now we're seeing more deals in the market. Nothing like pre-interest rate rise, but we're seeing sellers that are planning to sell. So, it's going to best and final, and whether we win or don't win the final bid, it's transacting. And we're seeing a pretty robust competition as well for these deals. We just missed out on a best and final on Friday that we thought we were very competitive on. And someone came in with a relatively big number. But we're not seeing as many institutional players. So there's some family offices, there's some other syndicators like us, and we're in the $12 to $50 million space as far as acquisition price. And, I don't see any of those names on there like BlackRock or, the big money Wall Street companies quite yet. And sometimes you see those trickle into these deals. So I do think that there's a value right now in that, some of the bigger players are being cautious. So there's an opportunity to get a good basis, but it's certainly very competitive.
Good. What are you seeing as far as the cap rate interest rate spread? You said you missed out on that deal. Maybe you can share some specifics, right?
Sure.
How many units was it? What city was it in? Right? What kind of condition was it in? What was the going in cap rate? What was the pro forma cap rate? Right? And what was the ability to raise the rents? Kind of that spread. And what was the interest rate that you guys were going to borrow at? Just kind of walk me through some of those stats if you could.
Yeah, sure. So it was a 312 unit that was about 40 minutes outside of Charlotte in a great area that had nothing in the pipeline. So it was well located between an industrial center and Charlotte, and it had nothing in the pipeline for the foreseeable future. So there's a good demand. The property was interesting. It was built in between 1985 and 2005, so in two phases. So there's sort of an older phase, kind of a mid 80s to early 90s phase, and then a late 90s to 2000s phase. And they had integrated it relatively well with, architecturally. The property had well below market rates, and all of the units across the board were all classic, meaning, kind of old style interior finishes, brown wood, beige countertops. So there's a big value add play, just getting rents to market and doing interior renovations. And overall exterior CapEx was not too bad. It needed maybe half new roofs, needed some porches fixed. It needed to have a full rebranding and kind of sign package to pull it all together. It felt a little spread out and almost like, am I driving through a neighborhood here, or is this a complex? So it needed to get a sense of cohesiveness. So the rate we were looking at was, we were assuming a 4.5 loan for the next 8 years. And then we're going to put a supplemental on top of that at 7.5. And then the in-place cap rate was 5.65 on a T3, T12. So the last 3 months of income and the last 12 months of operating expenses. And we were underwriting to a year one cap rate of 6.75. So there was actually a negative spread. If you lump those two, the supplemental and the primary loan, I think we're all in at a blended rate of 6.25. So in this case, the cap rate was lower. The in-place cap rate was lower than the blended interest rate. However, we were going to pass it after year one.
Yeah, interesting. Okay, great. Those are some good stats. I wonder and it sounds like a solid deal, right? Well located, good, sounds like good bones, good construction era, kind of a mix there. Lots of upside with classic units. and mostly a great assumption rate of 4.5. And so, okay, but still take a little bit of time to get that positive arbitrage on the debt, right? Take about a year to get that, but okay. And somebody paid even more than you did, right? What else could you have done besides pay more? In other words, why was the seller selling, right? Who was the seller? What was their motivation? I'm always curious on the capital gains tax. And I feel like people overlook this sometimes, right? And I'm just wondering who was the seller and why were they selling?
So the seller, relatively big player. They have, multiple thousands of units. And what I could get is that they had some kind of bad deals in the last like 3 years. They've given a couple back. They've had to do capital calls, and they got this deal at a good enough basis that they could give their investors a win. So it was sort of like a company strategic move to say, hey, we've underperformed on these last 3 deals, and we want to show our investors that we can do something. And they bought this property in 2019, I believe, at a great basis. And they're like, we can hit our numbers, so let's just sell so that we can kind of boost up the morale of our investor base.
Okay, that's fair enough. Especially if they give us some stuff back, they took their hits, but right. In the last couple of years, they didn't actually renovate any of the units. So that's kind of since 2019, what were they doing?
I don't know. That's a good question. And then the other thing that was kind of strange is they had their property management was. There's a bigger player in the area that owns and manages their own property. And this property was managed by that company, but there was no affiliation. So it was like they were a third party, but they were the only one, which is a strange setup. So, it's kind of hard, you do some internet research on these other buyers and you kind of push the brokers to give you more information, but we didn't get into detail about kind of why didn't they fix this place up? And
at the end of the day,
possibly they didn't raise enough capital.
Yeah, and at the end of the day, look, if the numbers make sense, you got to buy it on those numbers, not just on the story, right? The story is a part of it. We're talking with Chris Lento, emcapitalgroup.com, emcapital.com, and that's part of having multifamily investment insights, right? Is sometimes you are buying it more on the story and maybe less on the numbers. Hopefully it's mostly on the numbers, 80% and then 20% on the story. It's probably maybe a good ratio there. But at the end of the day, you have to go with what makes sense. And you guys did. You guys went with your best, and someone beat you out. Do you know how much they beat you out by?
Yeah, they beat us out by $800,000.
Okay. All right. So the question becomes, can they make up that $800,000 and with increases in rents and whatnot? And or the time that they can hold on to the property, $800,000 on a 312 unit apartment complex. Chris, any other insights to that deal? It looks like he might be in a frozen space. And so you can learn more about Chris Lento. We go to emcapitalgroup.com, emcapitalgroup.com. And we're here. This is Brett Swartz, Capital Gains Tax Solutions Podcast. And we're always trying to bring in some of the best real estate folks to discuss. Hey, Chris, I think you're back. Chris, you back?
Yeah, I'm back. Sorry about that.
Okay. All good. It happens sometimes. You have to refresh the browser there. So I was just saying, any other insights for this deal that you want to share?
Yeah, I think we could have taken this deal down if we had a little bit better strategy. So I think we had a little confusion on, the brokers have a team, and we have a good relationship with multiple brokers. And I have a team. This deal was going to be with my company, and then we were partnering with another company. And I think we were doing too many touch points with too many brokers. So I was talking to someone else on my partnership team was talking to someone, and I think we need to regroup and get a more cohesive communication plan. And I think we would have been in a better position to either increase our price a little bit, because there's kind of a game, like it's best and final, but then maybe you'll get into the buyer interview process, and at that point you might have to come up again when they come back at you. So I think we sort of could have played that game a little bit better.
Yeah, well said. Yeah, that's another good multifamily investment insight there on just negotiating, right? Making sure that you're communicating in a way that's cohesive and unified, and not between multiple parties. And so that's good insight. What other insights on just the multifamily world right now on what you would say besides just blocking and tackling, underwriting deals, sticking to your fundamentals, and finding and unlocking opportunities? Any other insights for what's going on in today's world?
Well, I mean, I know you're a tax show, so we did do a deal last year where we 1031 exchanged one syndication into another, and you don't see that as often. It takes a lot of, a normal 1031 has a lot of timing implications, and a syndication to a syndication 1031 has timing implications and pretty significantly complex tax implications, and the structure is sort of complicated. But if you can line that up, that's a great opportunity, because we found that raising for it was very easy. Because if you go to your investors and you say, "Hey, we got a great return on this deal, and we have another deal lined up for you. You don't have to do anything; just sign this form, and we'll roll the money over." It almost solves their problem, because sometimes when you give investors their capital back plus a 20 to 30% return, you've given them a problem. What do I do with this money? They typically didn't invest it with you because they, want that capital, want that return back in 3 years for something tangible. They want to grow their wealth. So if you can 1031 exchange, you're kind of solving a problem that you create for them in a very good way.
Absolutely. We call that building a capital gains tax exit plan, right? Which is, most people think about cash flow, but they don't necessarily think as much about tax flow, right? Which is it's before and after. And a 1031 exchange is great because it mirrors the tax flow and the cash flow, and it helps to increase the return, right? From just cash flow and tax flow, it kind of takes it and it keeps rolling and compounding. It's a compounding interest. So 1031 exchanges are great for that. Now the challenge of 1031s though, is sometimes you can't find that deal. The stars don't align. You don't have all the investors together. A lot of syndicated groups we work with don't do 1031s for that reason, unless it all works out, or they have a fund, Chris, and they don't accept a 1031 into the fund.
Right.
So we actually have built a strategy. It's called a deferred sales trust that allows you to trade, instead of trading into a like-kind property, you can diversify into a trust, but then you can roll it right back into funds or syndications, but there's no timing restrictions, right? There's no like-kind replacement requirement. You can sit in T-bills while you wait. We have people coming out of cryptocurrency and going into real estate, people coming out of stocks or business sales. Most of them actually want to be in multifamily, value add, or mobile home park funds, right? Or syndications that have a good solid rate of return and conservative underwriting, right? So just your thoughts on that. Have you ever heard of something called a deferred sales trust before? And what comes to mind when you know that any asset of any kind can exit and come in seamlessly without having to do a 1031 exchange?
So yeah, I have looked up into this in the past, and I will say I'm by no means I wouldn't even say I'm knowledgeable about it, but I'm aware of it. I think I read a book on it a couple of years ago, and I guess I didn't completely understand it, and I got the impression that there was sort of a transfer of control from my company of the real estate in the process over to someone else with a level of trust that would have to be built up. So it's sort of on my list of things to learn more about, but it's not something I'm intimately familiar with.
Yeah, you're spot on. Yeah, there is a third-party unrelated trustee. That's our role here at Capital Gains Tax Solutions. But it's kind of like a third-party qualified intermediary, whereas that transfer of control for a short period of time. Ours tends to be a little bit longer, right, depending on the deal and how it's also working out. Think of it kind of like an IRA or a 401k, right? You have like an IRA administrator or a 401k administrator. It's a third-party company. Think of it, and then a qualified intermediary, you're definitely doing that as well for that 45 to 180. Right. But you can invest right back into your own deals and do it yourself. It's kind of like a self-directed IRA, right? Where you can control an LLC, the managing member, majority partner, and the trust can come in and partner with you, and you can run your deal the same way you would have. It's really neat once you unravel it even further. But at first glance, a lot of people think, oh, it's just deferring tax, and I'm just putting the money into the stock market, and I'm not going to be an entrepreneur. And it's like, no, it's actually the opposite. And you can do that, Jim. You could be totally retired and do that. Most of our clients are entrepreneurial, business, cryptocurrency, and they want to run and invest with partners that they know, who have a good return. But the second part of this is, even though you give up some control from the trustee, number two, you get a new depreciation schedule. Right. So we're doing a deal right now in Sacramento, California. It's a $14 million sale. He has zero depreciation schedule. He has a $7 million debt. and the debt's resetting in a couple years, or actually in 1 year, from like 3% to like 6.5 to 7, which is crazy, right? His cash flow is about 20K a month right now. And he's going, wow, I got like the stick coming with the debt. I've got a huge tax of 40% of the gain on $14 million. It's about $6 million or so in tax liability. And he's like, what am I going to do? Like, if he tries a 1031, he's going to have to take on all this new debt and a new property. And he's over 70. And so we come in and we actually kind of save the day, and that we get him out of debt, get him diversified, get him tax deferred. And then we're able to move right into commercial real estate syndications, all tax deferred. And so that is that part where we focus on like, hey, what do you get for giving up some of that control?
Right.
And what are the pros and cons? No strategy's perfect, but that's a little bit more about the deferred sales trust. If people want to learn more, you can go to capitalgainstaxsolutions.com. And we did write a book called Building a Capital Gains Tax Exit Plan. You can check that out on Amazon. Any last thoughts on that, Chris, before we go to lightning round?
No, I mean, that's definitely, something I want to look into, and it seems like a very viable solution.
Yeah. Awesome. Thanks so much for sharing that. All right, here we go. Lightning round. Knowing what you know now, Chris, if you can go back to your 25-year-old self, what's the one golden nugget make sure to tell yourself to do?
Oh, I would have left engineering earlier. I would have just, made the jump quicker.
Awesome. Question number 2, what's the number one book you've recommended or gifted the most in the past year?
Who Not How by Dan Sullivan.
Awesome. Question number 3, what are you most curious about right now?
I've been kind of getting into geopolitics a little bit. I'm not sure if you ever listened to anything by Peter Zion. He kind of talks about, kind of the next 100 years of what the world's going to look like. So that's what I'm kind of been interested in.
Fascinating. I have not. Maybe I'll check it out. Next question. What's your number one leadership quote or theme that you strive to live by?
Oh, that's a good question. I think strive for excellence. A lot of times you can get into a trap where you're like, oh, I can do this a little bit better or slightly better than the next guy or better than average. And I think, aiming for best is like a invaluable approach.
Every day in every way, get a little better, right? Next question is, number one way you're using Chat GPT.
So I'm using Chat GPT to edit. So I have like a lot of newsletters and investor newsletters, and I just have my the person who writes those, dump them into Chat GPT just to make sure they're grammatically correct and make sense. Additionally, I've been using it to dump PDFs in of long market research documents and having it summarize them into bullet points, or just summarize them into nuggets that I can then use in marketing. So I would say generally it's kind of like marketing content and summarizing information. I can take a transcript from a YouTube, dump it in Chat GPT and say, give me the top 10 points, things like that.
Awesome. Absolutely love it. Last question. After you're helping all of you help create and preserve wealth with EM Capital and all the things you've done, how do you best stay centered in your values and stay encouraged to charge forward to reach even higher heights?
So, as a team, we review the core values of the company every quarter and try to kind of bring them up as much as we can. And I do think that they're not just lip service. I mean, if you kind of read them, you're like, oh, this is, this makes sense. Like, trust is extremely important in what we do. We investors, wire transfer us their money to put to work. And that is all about trust. So honesty, transparency are so key. And we just try to re-hit them as much as we can and integrate them into our kind of daily practice.
Amazing. Chris Lento, I want to thank you for being on the show. I want to thank you for sharing your wisdom on the multifamily insights, investment insights. I also want to encourage you to keep using your gift of connecting and translating complex investment strategies, different things for people to make it even simpler so people can take action on investing and getting some freedom with some passive wealth. For our listeners who want to get in touch with you, would you mind one last time? What's the best place for them to find you?
You can email me at chrislento@emcapitalgroup.com. or check our website out at emcapitalgroup.com. And then you can find me on LinkedIn as well.
Amazing. Thanks, Chris, for listening. Also want to thank our listeners for listening to another episode of the Capital Gains Tax. Thanks, Chris, for being on the show, but I want to thank our listeners for listening to our show or watching on YouTube. As always, we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy, especially the deferred sales trust, is an amazing way for you to eliminate the need for the 1031 exchange and have options when you go to invest, or just a backup plan. In fact, we just released the best 1031 exit plan. It gives you both options, a regular 1031 exchange and also the backup plan for the deferred sales trust. And we also work with people to do what's called a Delaware statutory trust, not to be confused with the deferred sales trust. In other words, we help you to build a holistic plan that gives you options and flexibility depending on what you're trying to do. When you're trying to do it, just go to experttaxsecrets.com to learn more about the best 1031 exit plan. And if you're exiting cryptocurrency, businesses, real estate that have $1 million net proceeds, $1 million gain, you can go to capitalgainstaxsolutions.com to get started there as well. And check out the new book, Building a Capital Gains Tax Exit Plan. We did hit #1 bestseller on Amazon, which is pretty cool, on the wealth and real estate category. So check that out. It's a proven playbook for unlocking your ideal wealth plan for selling assets of any kind for yourself, for your clients. That's called Building a Capital Gains Tax Exit Plan. Hey, everybody, thanks so much for listening. We